What if I told you that there's one stock that works perfectly with the wheel strategy, delivering consistent income month after month while minimizing risk? In today's video, I'm going to show you exactly what stock that is, how it's helped us generate a 31.1% return over the past 12 months, and why it's poised to continue delivering throughout the rest of 2024 going into 2025. And the best part is, you don't need to be a professional investor or options trader to use this strategy or to use this stock. But first, a quick intro. I'm Oliver El-Gorr, founder of Freeman Publications and investingcoach.com. Over the last 4.5 years, we've sold over 180,000 books on Amazon and coached over 400 students, helping them grow investment accounts all the way from $5,000 all the way up to $3.8 million. My mission is pretty simple. It's to empower you to safely and effectively manage your money without relying on overpriced advisors or wasteful wealth managers. And instead of giving you a broad overview of this company, I want to dive deeper into something a lot more specific. So recently, during a live training session, I broke down step by step why this stock is the perfect fit for the wheel strategy. And in this video, you're going to see that exact deep dive while I'll explain everything from the stock's fundamentals, why it's so reliable, and why in the last few months it's actually become the perfect stock for the wheel strategy. So get ready to understand exactly why this stock works and how you can use it to maximize returns from your own portfolio. So let's jump right in. Fantastic. So tonight we are looking at Broadcom. Give me a 1 in the chat if you've heard of them, a 2 if you have not. So we've got a nice mix of 1s and 2s here. I think Broadcom's one of those companies where a lot of people have probably heard of them, but a lot of people maybe don't know what it is they actually do. Because it's a massive company, $690 billion market cap. It is a very old company as well. It's 60 years old as of last year. They spun out of HP in the early 60s. They are one of the largest semiconductor companies on the planet. And it's a stock that's kind of been all over the place, especially in the past 12 months. But I'm going to explain tonight just what they're all about, why they are, I'd say, a little bit underrated when it comes to looking at the semiconductor ecosystem, but also some of the challenges that the company faces. So first heard about this in 2012, mainly because I was working in the industry, and by the industry I mean a company that had a Microsoft Asia system at the time. Company I worked for in the market research industry. We hosted a lot of our stuff internally on Asia, and so that's where I heard about Broadcom for the first time. So Broadcom is a company with 2 key revenue sources. So I'm going to go to the company presentation as always. This is in 2024, so it's very up to date, September. And first things first, it's massive. It's a bloody huge company. 35.8 billion of revenue. That's up 35% year over year. 21,000 patents. And like I said, they spun out of HP in 1961. And this led to what is the current company today. Sorry, 1991. I misspoke. The current company today known as Broadcom. They're also a serial acquirer. I'm going to go more into that later on because it's a key part of their growth strategy. So Broadcom itself has been around for about 35 years. Broken down into 2 segments revenue-wise. Semiconductor solutions, which accounts for about 60% of their revenue, and then infrastructure software, which is the other 40%. And this is kind of where all the good stuff is. Because we've got to take a step back for a second. Before 2016, before we start seeing the first rise with Nvidia and AMD, back then it was fueled mainly by the crypto boom, because a lot of these semiconductor companies were selling GPUs and CPUs for crypto mining units. That was the initial tailwind that really started pushing the semiconductor industry. Then we had the Internet of Things, these interconnected devices. But semiconductors have always been a cyclical industry, in that massive periods of growth followed by massive periods of consolidation, less demand, and then depressed prices for the stocks as a result of that. Now, Broadcom has a fairly diversified base when it comes to the semiconductor part of their business. Chances are, if you live in a home and you are watching this program, you have Broadcom chips in your home. They supply Apple, they supply Samsung, as well as the three big hyperscalers, namely Amazon AWS, Microsoft Azure, and Google Cloud, for their data center operations. So whenever I look at things like lifetime customer value, they got long-term deals with some of the largest enterprises on earth. Because if you're AWS, which is an $80 billion a year business, or if you're Google Cloud, or if you're Azure, chances are you're not really going to chop and change providers too much. You're going to look at one source, one provider, and develop a long-term relationship with them. So they've been a supplier for all of these businesses for a very long time, which is a strength, but also a weakness. Who can tell me what's happened to iPhones in terms of sales numbers in the past 3 or 4 years? iPhone's massive growth industry for about a decade. What's happened recently, though? Yeah, sales have basically flatlined, even declined a little bit. Now, I've got here under the red flag section, Apple has accounted for as much as 20% of Broadcom's revenue. It's not quite that high right now because of some other things they've put in place, but we've seen this with a lot of companies. They are basically tied to Apple. If Apple does well, they do well. Once sales start slowing, that company doesn't do as well. So one of the red flags I've got here is if iPhone sales continue to stagnate, then this is a no bueno. This is no good. But fortunately, Apple is not the only horse they've attached their cart to. So when we're thinking about where their revenue's coming from, a lot of it is in these enterprise level data center type contracts that they have, with stuff you're never going to see on a day-to-day basis, but stuff that powers the infrastructure that the internet as we know it is built on. So AWS, Azure, Google Cloud, between the three of those, that's probably 80% of the internet. Servers, routing, everything that underpowers our daily lives online, Broadcom has a hand in. It's why it's such a big company. But they also have a hand in consumer devices as well. I talked before about the Internet of Things, connected devices, but also, all the way down to stuff we're using on our desk right now. iPhones, laptops, AirPods. You name it, they've got their fingers in the pie. Umesh makes a good point. They're also a big player when it comes to 5G, which is only just getting started. So surely this is going to be like a dead cert, right? Surely that this is the kind of company we would be all over. Let's think about this in terms of an investment opportunity. First things first, it's a $690 billion company. It ain't small. In our model, I've got it as stage 10. If you're not familiar with what stage 10 means, stage 10 is a very mature company that's been consistently profitable for a long time. But the question is, how much more can the profitability continue to go? Stage 10 means I think it can still grow at a decent clip meaning 10 to 15% earnings growth per year. But once we move into stage 11, that's where I feel like that company can no longer achieve that. So how have they been able to achieve consistent growth, even recently? Those two letters that make up most of the investing conversation over the past 2 years. Anyone? Anyone can tell me what it is? I'll even underline them for you. Yeah. AI. Who can tell me why AI as a technology is so demanding when it comes to chip production? Why has NVIDIA gotten so big? Why have companies like Super Microcomputer run up on the back of the AI hype? Why is AI so demanding when it comes to chips? Jonathan says data. But what about the data specifically? Yeah, Steve's nailed it. In order to develop these AI models, not only do you need to process massive amounts of data, you need specific chips designed for that level of data processing. And so that's where companies like NVIDIA have been so successful. And whenever we talk about semiconductor companies, it's always important to sort of see where these companies fall in the ecosystem. I would not consider NVIDIA a direct competitor to Broadcom. I would say they are an indirect competitor. The best direct competitors to Broadcom in terms of public companies would be Intel, Marvell, and AMD. So NVIDIA would be an indirect competitor, but Intel, Marvell, and AMD would be more direct because they focus more on CPUs as opposed to GPUs, which is NVIDIA's wheelhouse. So AI revenue is now 35% of the total, which was up from 15% in 2023. But one of my favorite phrases in this industry is a strength overextended becomes a weakness. So what do I mean by that? If a company is solely reliant or overly reliant on this AI run-up, what happens when the capital cycle slows down? The growth cycle slows down. We're seeing this right now with the narrative around NVIDIA shifting, with the narrative around ASML shifting, with the narrative around Taiwan Semiconductor shifting. There's been a lot of bearish AI talk in the past 2 or 3 months. Stuff we didn't see in the first 2 years of this run. So in terms of the risk factors for this company, if AI spend decreases due to economic conditions, if these companies decide the juice isn't worth the squeeze of spending however many hundreds of billions a year on AI chips and not getting that subsequent boost in revenue because of it, That's a pretty tough thing for Broadcom. It's a pretty tough environment to be in. Give me a 3 if you're following along so far, if you're seeing the nuances about this company. So, fortunately, Broadcom is not just a semiconductor company. Because, like I said, we've got, where are we going here? Infrastructure software as 40% of revenue. And this is really where the current management has done a fantastic job. So the CEO, Hock Tan, has been there for the past 18 years. He is one of the most aggressive CEOs on Wall Street. And what I mean by that is he's a cost cutter and he's a serial acquirer as well. A lot of the acquisition has been done on the infrastructure side of the business. The two major ones being Symantec, cybersecurity, and then VMware was their big acquisition in 2023, which I believe at the time of recording this, September 2024, is one of the 10 largest acquisitions ever. So all industries. It was a $66 billion acquisition. And what a lot of these acquisitions have done to Broadcom's business is they've put recurring revenue into the business. So, like I've said before, semiconductor companies, traditionally it was a cyclical industry. It still is to a certain extent. But now they've got this recurring revenue element from the infrastructure software division. They have both the upside potential, but also the downside protection of what we look for in an investable company. Because what I think is going to happen in the next 5 or 10 years, and especially in the next 5 years, is we're going to see more consolidation in terms of semiconductor growth. And the other big prediction I have for the semiconductor industry over the next 5 years is Amazon, Apple, and probably Meta are going to spend a lot of money developing their own AI chips. They're going to take things in-house, and they're no longer going to be a huge source of revenue for a lot of these companies. We've already seen it with Apple. The MacBook Pro. For a long time, they were Intel chips inside. Then, 3 years ago, Apple decided, you know what, we're going to make our own chips instead. So Intel gets cut out of that deal completely. First, it's half the laptops have Intel chips, and the other half have Apple chips. Now, all the latest MacBook Pros are solely built on Apple chips. Can't get an Intel MacBook Pro anymore. And I think this is going to happen in the data center industry as well. I think companies like Apple, companies like Amazon, companies like Google, who are sitting on huge amounts of cash, are going to put that cash into R&D, developing their own chips. And so when I'm looking at a company like Broadcom, I'm thinking, what happens if their lucrative semiconductor contracts and lucrative semiconductor division, what if it's not so lucrative anymore? Where's the revenue going to come from? More importantly, for a company like this, where's the bottom line going to come from? For a $690 billion company, I'm not looking at revenue growth numbers necessarily. I'm looking at earnings growth numbers. And for Broadcom, the earnings growth hasn't necessarily been there over the past few years. It has been a lot better in the past 12 months, I will say that. But if you just look at the ratios, trailing earnings is 135 times earnings the stock's trading at. If we're looking forward, we're trading at 25 times earnings. So what does that mean? How do we interpret that data? Trailing PE and then forward PE is 25. If the forward PE is so much lower, what does that mean for us? A man's nailed it. We are looking at earnings increasing over the next 12 months. So earnings weren't great. Trailing 12 months, over the next 12 months, we're looking at a big jump in earnings. So not revenue, bottom line profits. Once again, I'm not focused on revenue growth for a $690 billion company. So there's a lot to like in terms of the moves they've made regarding specifically the infrastructure division. But when you're a serial acquirer, that comes at a cost. Out of everything I've got on the screen right here, what's the numbers or number that jumps out at people in terms of, oh, that's a bit scary? Anyone? Anyone? Because someone's already got it in the chat. Company's got $60 billion of net debt on its book. I mean, VMware was very expensive. But the money's got to come from somewhere. So there's a couple of things that happened there. First of all, they had to do some share issues, which means the shares were massively diluted last year. But also, money had to be borrowed. So there's a lot of debt on their books. Now, this isn't like we're looking at an early stage company who hasn't made any acquisitions and carries a ton of debt because their business model is flawed. This is a strategic move in that they believe they can borrow money at a lower rate than they will make money with the acquired asset. David says, what's the cash like? How much free cash flow they're making? Well, let's take a look, shall we? So statistics on stock analysis, straight away, I'm going to scroll down. I'm going to see, what are we working with? 10 billion of cash, 69 billion of debt. Gives us 60 billion of net debt. This is a free cash flow generating company. See here, they generated 18 billion of free cash flow over the past 12 months. So, and this has been a free cash flow grower over the past decade. 40% free cash flow margins. And whenever we look at this stuff, we have to look carefully about how much of that is stock-based compensation. 5 billion on 46 billion of revenue. So about 8%. That's fine. I'm okay with that. And you see the number jump significantly. Once again, that's because of the acquisition. Traditionally, this company has only paid out about 4 or 5% of their revenue and stock-based compensation. So when this jumps, the other thing that jumps is number of shares. So you see here, the number of shares jumped massively in the past 12 months as well. David says, why? Are you asking why stock-based compensation has jumped so much? Because part of acquisitions is VMware employees and management will have been paid in Broadcom stock as part of the acquisition. So whenever we talk about big corporate acquisitions, it's usually a multitude of factors. It's very rarely a cash-only deal. A lot of the times, the value is in shares of the acquiring company. So, for example, let's say, Freeman Publications gets bought tomorrow by Google, and we get bought for $30 million. 10 million of that may be in cash. 10 million may be in what's called an earnout, which is based on the business getting purchased, meeting certain revenue and earnings targets. And then 10 million may be in Google stock. So the headline number is 30 million, but you may only get 10 million up front. And for a long time, it was really popular to just do these all stock deals. So the company that got purchased, the employees actually made nothing because the company that bought them ended up tanking. Saw a lot of that in the dot-com boom. So just because there's a big number on the headline of this company gets acquired for this price doesn't necessarily mean the people are benefiting. But yeah, I hope that answers your question, David. A lot of the time with these big corporate acquisitions, we're going to see stock-based compensation increase. So when we look at true free cash flow numbers, we got to take out the stock-based compensation. So we're looking at 13 billion a year of free cash flow, which is still pretty solid. Now that's 33% free cash flow margins if we're looking at $46 billion of revenue. But a man made a very good point. We can assume in the future it will go down. And it actually has. If we look at the share change in the last quarter, buybacks are in place. So we've got 3% less shares in the last quarter already. So this is not a really heavily dilutive company. It was just they made their biggest acquisition in history, and naturally that's a one-time dilution because of that. In terms of some other hallmarks I look at, intangible asset advantage, they're one of the most well-patented companies on the planet. R&D out the wazoo, 21,000 patents, an extremely complex network of intellectual property. That creates a huge barrier to entry for competitors. That's why I say here, I'm not looking at like Intel, Marvell, or AMD as like stealing their business. What I'm looking at instead is, will their customers take things in-house? In terms of a moat, I would say it's a fairly strong moat that could get weaker. Definitely pricing power, but also switching costs due to these long-standing relationships with the major cloud providers and the major cell phone manufacturers as well. And I've even noted here in my notes, I think this is weakening. Because whenever we think about moats, we have to look at it in dynamics. A moat is not static. A moat can either be strong, weak, but on top of that is either getting stronger or getting weaker. So like we covered this a few weeks ago when we talked about Google. Google's moat was so strong that it's now become a weakness because of the antitrust lawsuit and the potential breakup we're seeing. So we always have to factor that into play when we're thinking about moats. Is it a strong moat that's getting stronger, or is it a strong moat that's getting weaker? And in this case, I think it is getting weaker. So a lot to unpack here so far. What I want to do now is I want to just pause for a second and then answer some questions that are going to come in before we go into the 10K and look at some potential weaknesses going forward. David says, so if we check goodwill and see if it increases over the years, that's because it was a good acquisition, right? So we'll need to see how previous acquisitions went. So the cool thing is, stock analysis, I only realized this today, they've broken out write-downs in the goodwill numbers. So this is really cool. So they actually have got asset write-downs as its own section. Because before, all we saw was one number. Now asset write-downs have been broken out. So you see here, there's very little in terms of write-downs. This is $8 million of write-downs on $46 billion of revenue. This is so infinitesimally small, it's not even worth thinking about. We've even got legal settlements broken out as well now. How cool is that? So they had $200 million of legal settlements last year. So in terms of your question, David, how did the previous acquisitions do? Did they pay a fair price to them, or did they have to massively write it down? In this case, no. Let's look at another one. Who did we look at before? Was it Microsoft with Nokia? Let's go and see with Microsoft the same numbers. Asset write-down. So where was the Nokia acquisition in all of this? So I can't remember if this was Nokia or if Nokia was before. No, I think this was Skype, actually. This $2 billion write-down here. Let's see Etsy's one, because that's more recent with Depop. They had, I think it was a $2 billion acquisition they had to write down $1 million of. So yeah, this impairment of goodwill, $1 billion write-down on a $2 billion acquisition. And then do a further write-down here. So when we look at Broadcom and their record of acquiring, they've had a pretty good track record. And this, I think, could be attributed to this gentleman, Mr. Hock Tan here. Any other questions so far about Broadcom before I get into some risk factors? And then really why I like this better as a wheel strategy type stock rather than a buy and hold stock. David, you're very welcome. You're very welcome, my friend. Oh, by the way, just for everyone here, in the logbook, I've automated some more of the formulas. So it's just going to auto-populate all of these now when you type in the ticker symbol. Just to help you out a little bit more with your own logbooks. So you see here, if I type in Apple, it changes everything. So if I've got no other questions, let's look at some 10Ks. As always with the 10K, where is the first item I'm looking at whenever we're analyzing a company? What's really the only item I spend a lot of time on? Ian's nailed it. Risk factors. This is the only time we're going to get the true look at the risk factors a company faces from their own mouth. So Broadcom, going to go down to the risk factors, and always I'm looking for company specific risk factors, not general ones, such as adverse global economic conditions could have an effect on us. That is literally every company on the planet. As Jonathan says, I'm looking for that risky business. So let's take a scroll down and see if we can find anything. We don't care about adverse economic conditions. We don't really care about regulations, although I will say when it comes to semiconductor companies, we should keep an eye on how much of their business is coming from China. Just because anyone who's read Chip War, our #1 book of 2023, will know this, there is a trade war between the US and China, and there are regulations in place around US businesses doing business with Chinese companies when it comes to semiconductors because of the concern around intellectual property theft and things like that. So you see here, this is the kind of things we look at. Very specific examples. For example, Huawei, one of our customers, is subject to certain US export restrictions, which has required us to suspend sales to Huawei until we obtain licenses from the US Department of Commerce. So straight away, that's a potential risk factor there. Now, Huawei isn't a huge part of their business. It's certainly not a major customer like Apple or Samsung would be, but it is something to be slightly concerned with. One of the big questions, and David brings up a good point from something he read in The Intelligent Investor about being careful of serial acquirers. You know my thoughts on serial acquiring companies. I think it only makes sense if they are at the size where organic growth is more difficult. I think in the case of Broadcom, you could argue that they are one of the best serial acquirers of the past 20 years, especially from a business that isn't designed that way. You know, you've got companies like Constellation Software where they're built for acquisition, and that's really their only growth pathway. But for a company that has organic but also acquisition-led growth, I think VMware have done a fantastic. Sorry, Broadcom have done a fantastic job. But you know, the VMware deal was big. Like I said, seventh or eighth largest acquisition ever. So they say here, as part of our integration of the VMware business, we plan to focus on VMware's core business of creating private and hybrid cloud environments among large enterprises globally. If VMware customers do not accept this plan, the investment we have made may be of no or limited value. We may lose customers and our results may be adversely affected. So whenever we do a big acquisition, especially one that's involved debt, we got to be a little bit more mindful of the company at heart. They plan on continuing to pursue acquisitions. You know, we have the key person note. You know, these are very popular these days, especially for like a long tenured CEO. Not something I particularly am concerned with. Any business that's in IT has, you know, obviously cybersecurity concerns. Once again, not something I'm going to be specifically concerned with looking at this business. They do mention that the semiconductor industry is traditionally cyclical. I actually would like to go back in Nvidia's 10K and see if they mention this, because I know Jensen doesn't believe it. But this is why I say I like Broadcom as a business, because they don't just have the semiconductor part of their business. So here's the other one. The customer concentration part. We've talked about this a lot before. I don't love that a business is solely reliant on one customer. In fact, we really try and avoid businesses like that. You know, we looked at Perion Network at the beginning of 2023 and how they were pretty reliant on Microsoft. We've since seen how that has gone. Spoiler alert, not well. And so aggregate sales through all channels to Apple and our top 5 customers account for 20% and 35% of our net revenue, respectively. So Apple is still 20% as of 2023. 35% of their top customers, so top 5. I would imagine we can name the top 5. Apple, Samsung, Amazon, Google, Microsoft. I might be wrong because they don't call it out within the document itself, but I'd imagine it's those. Maybe Oracle or another one of the cloud businesses in there as well, but I'm, you know, not 100% certain. So there is that. And here's the part where I am also a little bit concerned. Customers' purchasing power has, in some cases, given them the ability to make greater demands on us with regards to pricing and contractual terms. It also means they could turn around and say, you know what? We're going to make our own chips. This has been a big question mark in the semiconductor industry over the past couple of years, especially with the growth of AI. Now, here's one of those things where industry knowledge comes in really useful. They talk about, hey, Taiwan Semiconductor does 90% of our manufacturing. Guess what? Most semiconductor companies who are fabless rely on either Taiwan Semiconductor or Samsung. So I'm not too concerned with that. This is why I've been so bullish on Taiwan Semiconductor long term, because none of this exists really without them. And one step above that, none of this really exists without ASML. That's why I've been so bullish on them long term. So not a massive concern for me, but it's good that they mention it within the 10K. Talk about potential disruptions, legal proceedings. California Institute of Technology sued them. They settled in 2023. And because of stockanalysis.com, we now know how much they settled for. $204 million. This is useful, right? Going through the 10K. Let me know if there's anything that stood out to you guys in particular. Don't mess with Caltech, says William. Yeah, good point. Good point. Anything else? Oh, don't mess with Caltech. Are we concerned about Apple being 20% of their revenue? David says, one of the hardest parts for me is separating general risk from specific risks. The easiest way that I've found to do it when you're looking at a 10K is the more specific the example and the more detail in the risk factor, the more specific it is. So for example, they talk about this lawsuit by Caltech. It's not just we're involved in legal proceedings, that may be bad. So for example, here, this is a generic one based on being in the semiconductor industry, because all they do is talk in generic language. The Huawei one, once again, specific example. Huawei was a customer. They've had legislation and regulation against them. Therefore, it's going to impact our business. The Apple one was specific. They named Apple in there, not just if too much of our products are concentrated on one customer, that could be bad. The more specific the language, the more specific the risk. So William says, I agree. Apple and their other big customers will try to develop AI chips in-house. And that for me is kind of the elephant in the room here, why I would not want to own this long term. But they did something. Broadcom did something in the past year that's actually made it a fantastic stock for the wheel. Can anyone tell me what it was? Because when I saw this, I was very, very happy. A man has nailed it. They did a 10-to-1 stock split. So 6 months ago, Broadcom was a $1,600 stock, which meant you needed $160,000 of buying power to sell one cash secured put option on it. Today, it's a much more palatable $14,800. They did a 10-to-1 split. So if you've got a mid-sized account, so we're talking like high 5 figures, low 6 figures, this stock is now in play for you with the wheel. A few things that I like here. Number one, company's not going out of business tomorrow. First and foremost, that's my primary concern with any stock I'm going to sell options on. What's my downside? We got a dividend payout. So if I am forced to own it for a little bit, cool, get a bit of extra cash. In terms of premiums, let's take a look-see, shall we? I'm going to load up Tasty Trade as well. And I'm going to just see what kind of premiums we can get. Because knowing this stock, they are not massive by any means, but they're pretty generous for the kind of company that we're at. So just give me 1 second. I'm going to share my screen. And let's hope Tasty Trade doesn't glitch out on me. So this stock is right in the middle of where we like to be for volatility levels on a stock to sell puts on. Implied volatility 30 days is 44.6%, right in the middle. Currently trading at $148 a share. We've got weekly options, which is great for flexibility. We've got tons of volume here, tons of open interest as well, hundreds of contracts per strike price, and a bunch of open interest on top of that. So in terms of if you're interested in selling puts on this, I'd be looking at either the 140, or if I'm going to be conservative, probably the 135 strike. The 135 is going to pay you roughly 1.6% for a 30-day trade. That's a 20 delta. Your cost basis, if assigned, is going to be 132. So you're already 10% below where it's currently trading at. And this is the kind of stock where if I could sell some conservative put options and get it to the point where I can have my cost basis at assignment around the 125 level, that gives me a really nice base to sell covered calls on. Because even if you're selling very conservative calls, so right now I'd be looking at, let's say, the 165, 170 level, getting my 1% for a very conservative call, essentially creating a 12 or 13% dividend for myself each year with capital appreciation upside, that's the kind of stock where if I'm selling puts and if I'm running the wheel in a conservative fashion, this kind of stock is perfect for it. That makes sense to everyone? Give me a 6 in the chat if that makes sense. David asks the question that I ask myself every day. Do you think Mercado Libre would do a stock split? As much as I hope they would, I know for a fact it's not on the cards anytime soon. Because most companies don't care about the ability to sell options on the stock as a desirable thing. It's only when you get to a very mature level and you know you've got a big retail investor base that it becomes a conversation that happens in the upper echelons. So I think the best examples of the past 5 years, Apple, Tesla, and Nvidia have all done stock splits. All three of them had a big retail investor base. And what do retail investors love? Lower stock prices. We know that it doesn't matter at all, but still, for 90% of the people out there just buying stocks on a Robinhood or whatever it may be, they're going to say, oh, Tesla was 250, now it's $70 a share, let's buy. And so that in itself is the conversation that's had. Chipotle, another great example, Steve, thank you. Chipotle was unique in that it was a $3,000 stock. They did a 50-to-1 split. Very rare you see a 50-to-1 split. I actually can't remember the last one. 10-to-1 is generous. Both Broadcom and Nvidia did 10-to-1. Most of the time you see an Apple or a Tesla, which is 3 or 4-to-1. But 50-to-1? Wowzers. But I know Mercado Libre management has basically said that they don't plan on splitting the stock anytime soon. A man says, what was Amazon? Amazon was 20-to-1. So Amazon went from about 3,600 to about 180 a share. Which, once again, that was a big one. And those all happened in that 12-month period of like mid-2020 to mid-2021, where we had money printing, pandemic craziness, and huge retail investor interest for the first time ever. Much of which has gone away and has not come back, by the way. So if you watched that far, I'm guessing you're pretty serious about this and about your financial future. There's a ton of resources in the description box down below, including the actual Google Sheet that I use to make these deep dives. So you can grab that. And hey, if you want to have a chat about potentially working with us to implement the wheel strategy into your portfolio, deliver consistent returns month after month, there's a link in there to book a chat with myself or one of the team. So, hope you enjoyed this video, and I'll see you in the next one.